Hello, I am Mr. Jackie and welcome to my workshop channel. In my channel, I will share with you my personal insights, tips, analysis and entry strategies for investing in the international gold market. If my views can help you to get good returns and profit, please help by liking, subscribing and sharing my videos with your friends, and feel free to discuss and contact me in the comments section. Thank you all. Last week's spot gold trend was consistent with my forecast. Gold prices continued to decline, the highest at 1985.31, the lowest at 1936.65. The weekly decline volatility was $48.66, closing at $1,945.07/0 ounce. Spot gold prices continued to fall under pressure amid optimism surrounding last week's U.S. debt ceiling negotiations and continued hawkish comments from Fed officials that reduced safe haven demand for gold. U.S. Treasury Secretary Janet Yellen announced last week that the final debt ceiling date would be postponed to June 5, showing the enthusiasm of the White House and the Republican Party in dealing with the debt ceiling issue, while the strong U.S. economic data released last week heated up expectations for another interest rate hike by the Federal Reserve, and the reassessment of the interest rate trajectory injected vitality into the dollar long, and gold prices were weighed down significantly. Last Thursday, the U.S. released that the first quarter gross domestic product, GDP, data was revised up from 1.1% to 1.3%, which was positive for the U.S. dollar, and gold prices continued to fall. The core PCE price index, April, released on Friday came in at 4.7%, better than the expected 4.6% compared with the previous reading of 4.6%. Durable goods orders, April, rose sharply to 1.1%, well above market expectations of -1%, but lower than the previous reading of 3.3% after the data released. Spot gold prices fell sharply to a weekly low of 1936.65 support. The University of Michigan Consumer Confidence Index, May, on the same day came in at 59.2, better than expected 57.7, the previous reading of 63.5. The overall positive economic data released last week showed that the U.S. economy is still in good health, driving up market perceptions of a Fed rate hike in June. The market now generally expects no rate cuts until 2024 and expects a 50.6% probability of interest rates remaining unchanged at next month's FOMC meeting, 14 to 15 June, with the probability of a possible 25 basis point hike rising to 49.4%. The probability of interest rates remaining at current levels in July is 25.5%, with a cumulative probability of a 25 basis point hike of 50% and a cumulative probability of a 50 basis point hike of 24.5%. My personal analysis is that the short-term to medium-term direction of spot gold is mainly guided by two major events that the market generally focuses on. 1. Whether the U.S. debt ceiling will eventually reach an agreement between the two parties to raise the ceiling. 2. The future direction of interest rates of the U.S. monetary policy. In my view, an agreement between the two parties on the U.S. debt ceiling must be reached eventually, due to the special international status of the U.S. and the U.S. dollar, and the history of 80 suspensions or increases in the U.S. debt ceiling since 1960 is sufficient proof, but it is uncertain whether the debt ceiling agreement can be reached before June 5 next month, or within a short period of time after the expiry date. The failure to raise the debt ceiling by the last ex-date when the last President Trump was in office led to a shutdown of the U.S. government and the downgrading of the U.S. credit rating by international rating agencies, all of which could happen again. As for the future direction of interest rates, I believe that the Fed should keep interest rates unchanged in June and July, as the long-term debt problem of the U.S. has caused global countries to lose confidence in the U.S. dollar and U.S. dollar assets, and the pace of de-dollarization has intensified. After last month's rate hike, the Fed will be more cautious in observing more economic data before making a decision on monetary policy. It is worth noting that gold prices are being supported by the recent trend of gold buying and central banks buying sovereign gold, keeping gold prices on an upward trajectory in the long term. Therefore, the investment strategy should be to absorb gold at low levels for medium to long-term hedging and high-yield returns. Gold prices should continue to break up and make new record highs. Key U.S. economic data and events this week. Tuesday, May 30th, CB Consumer Confidence, May, forecast, 99.1, previous, 101.3, Friday, June 2nd, U.S. unemployment rate, May, forecast, 3.5%, previous, 3.4%, non-farm employment, May, forecast, 195K, previous, 253K. A number of Fed officials are scheduled to speak at various forums this week. Investors should pay more attention. How to confirm that the future market gold price will hit a new historic high. From technical data analysis, spot gold soared from a low of 1804.59 on February 28 this year to a record high of 2077.86 on May 3, after the gold price showed a healthy profit-taking adjustment, and the reasonable gold price should be adjusted to 1941.22 or 1908.97 support level after the end of this adjustment. Last Friday, gold prices found support after seeing the weekly low of 1936.65, and firmly held the 1941.22 support level provided by my prediction, error range, minus $4.60, that is, 1936.62, is not broken, so it can be assumed that this gold market adjustment has been completed. This time, gold prices have retraced from the all-time high of 2077.86 to last week's low of 1936.65, a total of $141.21, and this wave has completed 5 waves of this correction wave. One wave, 2077.86, fell to 1999.36, 2 wave, 1999.36 rebounded to 2048.15, 3 wave, 2048.15 fell to 1951.87, 4 wave, 1951.87 rebounded to 1985.31, 5 wave, 1985.31 fell to 1936.65. Since last week, the gold price is entering the last, 5th wave, stage of this round of correction wave, and fine support is not broken, so it can be temporarily confirmed that the gold price has reached the short-term bottom at 1936.65 support. If the support level in the future market is not broken, spot gold will enter the next round of upward pushing wave. To confirm that the future market gold price will successfully break through 2077.86 and then create a new historic high, the condition is that the future market gold price must break through the important resistance of 2057.94, error range, plus $4.6, that is, 2062.64. Successfully breaking this resistance level can confirm that the spot gold price will conservatively test the new historical high of 2113.16. Note, if the 1936.65 price breaks below next week, gold will test the 1908.97 support, error range, minus $4.60, before completing this round of adjustment and re-entering the upward market track. Strategy recommendations for this week. Resistance, 1971.95, 1990.59, 2007.25, 2023.91, 2044.53, 2057.94, 2113.16, 2165.12. Support, 1943.51, 1936.65, 1908.97, 1869.08, 1843.12. Main range of the week, resistance, 2023.91, support, 1936.65. Daily resistance, 1971.95, support, 1943.51. Note that the strategy has absorbed long at a low level, and it is recommended that gold prices this week be close to absorbing in the range of 1943.51 to 1936.65, breaking the 1936.65 price stop loss, absorbing near the 1908.97 support level, breaking the support level minus $4.60 stop loss. And the medium and long-term profit targets are 2113.16, 2165.12. This concludes the sharing of this issue. The above analysis is purely personal and for your reference. Looking forward to seeing you again in the next issue. Thank you all.